Hey traders. I want to make a little video about something that I think is really important if you're a swing trader. For day traders, it isn't as applicable, but it's something that I believe is really super important. As I cruise the internet and YouTube and all these trading educators these days, especially when it comes to swing traders, I think that people get really lost. And I'm going to make this video to teach you the real truth to why stocks move. And I'm not talking intraday. Sometimes it happens intraday, but over a 1 week, 2 week, 3 week, 4 week period. Okay? First, let's get the disclaimer out of the way. And I just want to say that this is not investment advice. This is just my opinion. Yada, yada, yada. And let's hit some charts. Okay? Now, um, everybody's looking at these charts for patterns, indicators, flags, pennants, whatever, head and shoulders. Here's a nice head and shoulders pattern right here. Um, you could say this is the head, right? Here's the shoulder, here's the head, here's the shoulder. Breaks down. Oops, it doesn't work. But I don't see a clear head and shoulders pattern. Yeah, it was there. It was there, etc., etc. Now, I think that everybody misses the absolute most important when they swing trade, especially. They miss the absolute most important part of on the chart. Okay, anybody know what that is? Right? How about these little numbers down here? Right? Ever wonder what they are? Right? We get so far away from these numbers, right? Now, I'll tell you why people get far away from these numbers, because they don't understand why and how they work. But yet they're really, really, really simple if you can just understand the whole reason why stocks move is because of this reason here. Why do stocks move? The key word here is expectation of future earnings. Expectations of future earnings. Okay? So this is where we get a little bit complicated and where it requires a little bit of explanation. Okay? So let's just say that I am interested in taking a short on Tesla, which I am. Okay? Now, why am I interested in taking a short on Tesla? Because you can see here that at their last earnings, which was on August 1st, the earnings expectation was for minus $2.73, and it came in at minus $3.60. Right? Now, all I want to know is, is that a good thing or a bad thing in context? In context, okay? So if I take a look at where the previous earnings were, minus 335, minus 305, well, maybe based on those previous earnings, maybe the stock could go higher, right? Because they're not losing since, pretty much the beginning of the year, they're not losing more money, right? They're actually, about where they should be as far as the year is concerned. But if we go back to last year, they're definitely losing a lot more money, aren't they? What about the year before? Absolutely. And the year before, they're definitely losing a lot more money. The company was profitable. Go figure that. Back in October in 2014, and now it's losing money. So in context, this stock to me is its valuation at 298 is way overvalued, right? Because the stock, even when the stock was making money, it was 130. How in the world can it be trading at $300 double now when the stock is losing money, right? And enough time has gone by. So the expectation of future earnings. So when I'm looking at shorting this, you gotta, that's where I start. I just, when I'm swing trading, I just look at the earnings and look at the pattern in the earnings. Now the next thing I want to know is at minus 306, where was it at minus 335? So you can see here that when we reported earnings back here at 335, the stock was 295. So now that we're back at 306, which is pretty close to where we were, it really did nothing, did it? All it did was have this big spike up and big spike down, and now we're back to where we should be, which is, so it's telling me that at 306, this is valued currently right now at where it was when it was around this price. Now what about over here? You can see here it was 304. So it looks like, at least what the market is pricing in right now, we're not too far away from what is perceived as good value. But in the bigger picture, when we were only losing $1, $1.33, $3, we're actually a lot lower where we should be. But are we proportionately lower to what the decrease in earnings are? So seems a little complicated, right? So I'm going to break it down for you really, really simple so that it's not so complicated and you can have a way of looking at it. All right, so I'm going to just take a look at this period right here because it's a little easier to do. So the earnings were minus 58 cents right here. And we can see that the stock was $238.84. Now, watch what happens. Price drops to this point right here, which is, that's a 36% drop. Okay? The earnings come in at minus 87. So people might say, and here's where people get confused, they might say, wow, those earnings suck. The stock's going a lot lower. But they forgot to take into consideration, where was the stock when it was minus 58 cents? It had been priced into the market. Okay? Now if you couple that on top of the fact that they probably came out with some type of positive expectation or some announcement of something new at that earnings call, it's no surprise that the stock rallies from that low all the way as high, right? Stock almost makes a 78% move from that low and then settles in here on the earnings date. Now those earnings come in at minus 57. See that? So people might say, oh wow, that's better. This company's not losing money, as much money as they did last quarter. The stock's going to go higher, right? No, you forgot to price in this earnings move. Okay, so it's no surprise here that the stock drops all the way to this point in time here. Now, again, pay careful attention. So now they come out with minus $1.06. Okay, where was the stock at minus 57? The stock was valued around here. So is it any surprise, because it was not priced in? If it was priced in, we would be probably somewhere around there, or even lower. Is it any surprise it sells off? Right? So the problem with most people, and when it comes to earnings, is they don't take into consideration the prior moves. Again, let me repeat this, okay? Stocks move on expectation of future earnings, all right? expectation of future earnings. Why is Tesla up here at $230 and the company's losing more than it ever did in history? Why is it? Why isn't it way down here at 118? Okay, because there's some future expectation that's holding it up there. Anybody know what it is? Yes, that's right. Delivery of the new Model 3 and potentially bringing out a Tesla truck and a Tesla Roadster. It's those future expectations that are holding this market higher. Okay, that's it. That's the only way that this stock can be trading at $300 and be losing so much money. The future expectations. Okay, now I happen to think that's utter and complete crap, and I think we're going to drop a lot lower. Will it happen tomorrow? No, it probably won't happen tomorrow unless there's a major upset at the company, which I do think potentially something's going to happen. But right now, I have to gauge this minus 306 on where we were at minus 330 and where we were at minus 304 and where we were at 3. Because all this whole period in here is all the new future expectation of the company. Does that make sense? Because this is probably when they started announcing their new product. If I'm not mistaken, the new products were announced at at this earnings, but the expectation for delivery of the Model 3s was, coming out back here, and we started getting close to that. Okay? So it's a little complicated, but it's not really. All you have to do is break it down, look at where am I right now, minus 306, right? Where am I compared to 335? Not far, right? Where am I compared to 304? Yeah, I'm lower, right? So, potentially that is a good value in relationship to this. And where am I at $3? Right, here's $3 right here, right? Where were we at $3? Well, we're losing more money since $3 and we're a little lower. So that makes sense. Right? Can you see how I did that? Forget about this one here. Right, look at that. In relationship to the new valuation on the new products, the potential future earnings, we're approximately where we should be, right? So in the short term, if I was thinking about trading Tesla in the short term, I don't think we should, I don't think it's a good short right this second, right? I think that if it gets back up to 340, 320 area, that's where I should be looking at shorting it, because then I can lead against these existing earnings that are in play in relationship to these earnings. Okay? Now there's a very complicated thing that I tried to just break down to you, and I don't know if I did it successfully. But the takeaway that I want to give to you guys is this. The takeaway is this. Don't get too far if you're swing trading. Don't go too far away from the most important thing that you want to understand and you must know when you're swing trading. What is the expectation of future earnings? Okay, and maybe if I expand this, in relationship to current earnings. Okay? In relationship to current earnings. And there you have it. Patterns, all that stuff. I use all those technical indicators, not indicators, but I do use patterns and I do use order flow. So when I'm looking at this stock, and my order flow students will know, we got some nice liquidity down here at 243, and I think we're going to hunt that eventually. So I do want to get short this stock. I didn't have the balls to pull the trigger up here at 380 like I should have, but at that time there was all this talk about a 420 buyout, and I should have had the balls to do that, but I didn't. And then by the time that came out, that move was just too fast for me, right? So now we're getting close to it. I do want to get short Tesla, looking for a test of 243. There's a bunch of liquidity down here. I do think over the longer term, this stock should be valued somewhere around $80, $70, right? But you have to accept the existing reality, right? I have to accept that even though the stock is way up here in these nosebleed levels, for the last 1, 2, 3 quarters, the market has agreed that that's what it should be worth based upon the expectation of future earnings. Make sense? Okay. Don't get too far away from it. It's not that hard to do, right? You just have to use a little bit of common sense. Ask yourself, where is the stock now compared to where it was in relationship? Again, a perfect example is this one. The stock was minus 58, minus 48, minus 36, minus 13. You think at minus 87, you think that that stock was going to go lower. But what you fail to take into consideration is, where did it come from? Was it priced in? Make sense? Okay, hopefully that was helpful. Thank you, and bye for now.